Good Friday morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. Treasury Secretary Scott Bessent tells us he backs a strong dollar as he looks to project a sense of stability in US economic policy. We'll preview today's key jobs data from the world's largest economy. Amazon falls post-market after sales forecasts fail to deliver. The CEO warns its cloud computing business can't keep up with AI demand despite plans to invest $100 billion this year. Plus, investors raise bets on more UK rate cuts after the Bank of England downgrades its growth forecast. We bring you our interview with the Governor, Andrew Bailey. We have the earnings crossing from the Spanish lender Sabadell, and it's a beat on net income coming in the fourth quarter at 532 million euros. The estimates had been for 428 million, so a solid beat in terms of net income for the fourth quarter. A key line on return on tangible equity and the projection around 2025 seeing an increase of 14%. An increase of 14% above the estimates of an increase of 13%. This stock, by the way, up around 130% just in the last 12 months. So again, a solid beat when it comes to the net income. The forecasts also raised in terms of return on tangible equity above the estimates. They see 2025 cost of risk at about 0.4%. That is a stock to watch at the open, 8 a.m. UK time, given the performance over the last 12 months, a Spanish lender that has performed very well and the earnings coming through with a beat. Let's get to the market story then again, because it was the earnings story that powered European stocks to fresh record highs yesterday, notching gains of more than 1% across the Stock 600. The story today seems to be a bit of wait and hold before you get that key jobless data out of the US, of course. European futures pointing to losses of 0.3%. But again, after the solid gains that came through yesterday, FTSE 100 futures currently pointed by 0.3%. The rate cut from the BOE and the adjustments around the growth forecasts and inflation being digested by these markets. S&P futures pointing lower by 0.1% after gains of around 0.4 yesterday, about 0.5 for the Nasdaq 100 futures, pointing lower there by 0.1%, with the focus, of course, on Amazon and the forecast around the current quarter disappointing. Let's flip the board and have a look cross asset. Yields currently up around 1 basis points on the benchmark 10-year. That is the focus for the Treasury Secretary of the US. It's not about pressuring the Fed. It's focused on the 10-year and moving that yield lower with increased energy costs, increased energy production, lowering costs around the energy story. That is his focus. And again, saying he wants to see a strong dollar. The pound at 124 so far in the session, just down 0.1% after the weakness of yesterday, given the mixed results that came through from the BOE, at least the mixed messaging, it seems, for some out there, given the changes from the hawks to a dovish position from Catherine Mann. $74 a barrel right now on Brent, currently up 0.4% on oil, gold at 2,861. Let's have a look at the Asian markets where the tech story is front and centre. Deutsche Bank putting out a note saying that investors will have to move pretty aggressively into Chinese stocks, given the innovation that's happening in AI, the innovation that's happening in electric vehicles. And the HS Tech Index is close to a bull market. In fact, it's added about 50% since September. That gauge currently up 1.2% so far in the session. Mainland stocks also gaining 1.2% on the CSI 300. The benchmark across Asia up, as you can see, about 0.3%. The Nikkei, though, feeling a little bit of pressure. Over in Japan, losses currently of 209 points. Let's get to our conversation then with the US Treasury Secretary, Scott Bessent, saying he favours a strong dollar. He has no plans to alter the government's debt issuance plans. Bessent showing a cautious approach then towards financial markets from an administration that is elsewhere rapidly upending the status quo.
First of all, the strong dollar policy is completely intact with President Trump. And I was very happy at his Economic Club of New York speech in August when he reemphasized the importance of maintaining the dollar reserve currency status.
OK, let's get more with Bloomberg's Mark Cranfield from our M-Live team. Mark, how are bond traders then reacting to Bessent's comments on the dollar and yields? He seems to be walking back some of his previous criticism around the issuance at the front end.
Generally speaking, there's quite a bit of relief about what we've heard so far from Mr. Bessent. They're particularly happy to hear that he's got no big plans to change the quarterly refunding issue for now. There was some concern once the new president came in that there will be higher issuance of long-term bonds, that generally the US Treasury will be looking for ways to fund the expansion, particularly some of the lost revenue they may get from taxation or other measures they're trying to do. They'd need to issue more bonds. That doesn't appear to be the case for now. He's saying that there's no need, especially to do anything with the long end. That's music to the ears of the bond market. They're happy to hear that. There will still be plenty of issuance in the short end. So what we are seeing is a flattening of the yield curve. That's been the major theme for the past few days. That's continuing to happen. We've seen a revival in interest in the 30-year sector, for example, in the Treasury curve. Now, there's not so much that he can actually do about pushing. He would like 10-year yields down lower. Most presidents and most Treasury secretaries would. But actually, a lot of it is out of their hands unless they're able to conjure up a fiscal surplus, which doesn't appear to be on the cards for now. In fact, that's the one thing that investors would like to hear more from Mr. Bessent, is how is he going to address the current deficit in the US on the fiscal side and the current account side. Those are problems for the medium term. For now, though, investors are relatively reassured that he's not playing around with the quarterly refunding.
Mark, when it comes to the jobs data out later today, it's the big print of the day, of course. Markets currently pricing in about 42 basis points of additional cuts by the Fed by the end of this year. What are you going to be scrutinising when it comes to the jobs data and how that informs our understanding of the next steps for the Fed?
This is a complex one today because there's going to be a lot of revisions. So people may be spending so much time going through the revisions to previous data that the net effect on the market may actually not be that great, because it'd be hard to get a substantial picture. Bloomberg Economics thinks that overall, once you digest all of the changes, there'll be fewer people employed, that in general, the revisions will be to the downside. Probably at the end of the day, that the thing that really matters the most is the unemployment rate itself. It's expected to stay at 4.1%, which is still a very strong situation for the jobs market. Probably soon after the data comes out, people already will be looking ahead to next week's CPI inflation report. That one is probably more significant because overall, that's what the Fed is concerned about. That's where people are thinking there could be an uptick in inflation again as the new policies from the White House come through. So that probably carries more weight. In the meantime, we've got a lot to digest from the payrolls today.
OK, Bloomberg's Mark Cranfield from our MLive team with the setup there as we lead up to the job sprint out of the US today. And then, of course, inflation data, as he says, arguably more important next week. Meanwhile, Bessent says he, the Treasury Secretary, of course, personally vetted the Treasury employees on Elon Musk's government efficiency team. The US Treasury Secretary says those members will have limited access to federal payment data.
There is no tinkering with the system. They are on read-only. They are looking, they can make no changes. It is an operational program to suggest improvement. So we make 1.3 billion payments a year. And this is 2 employees who are working with a group of long-standing employees.
OK, from the US Treasury Secretary to the Bank of England right now, which, of course, has warned that inflation will rise sharply this year and has downgraded its UK growth forecast. The bank cut rates by another 25 basis points, as expected, of course, yesterday, with 2 MPC members voting for a bumper cut. That was not expected. It also added the word careful to describe its approach to future cuts. But Governor Andrew Bailey warned against reading too much into that.
It's meant to say, look, there is more uncertainty. Don't take from that a particular directional message, other than I still think the path is down.
Yep.
But the world is more uncertain.
Let's bring our UK correspondent Lizzie Burden, of course, was outside the Bank of England yesterday and assessing and reporting on all of this for us. Was it mixed messages from the Bank of England? How have traders been reacting to what we've been hearing and that decision around the vote?
Yeah, mixed signals is definitely how I would summarise this. The decision itself was what we expected, but the vote split was not. You actually had two members wanting to do things by halves. Swati Dhingra, we know, is the archdove of the committee, but Catherine Mann, to go from the archhawk to joining Swati Dhingra, that was a shock to many. Except, I will say, the Markets Today Live blog, the eagle-eyed watchers there know that Catherine Mann is an activist at heart. But look, markets initially took this as a dovish cut, and then we heard Guy Johnson talking to the governor, asking whether that was the right interpretation, and notably the governor kind of saying that this is not a signal, the vote split in itself. Notably, where previously they had used the word gradual, as you say, they've added the word careful to that. So the question now is whether March is going to be a live meeting for a cut, if they're going to speed up past this quarterly cadence of cuts. Markets were, as you say, confused by the signals. At first they added to easing bets, then they came back to just over 2 cuts this year. You had long-term government borrowing costs actually up by the end of the day. So perhaps you could say that Bailey got the market right where he wanted it by the end.
Meanwhile, not so much of a gift for the Chancellor. In fact, some pretty dire warnings around both growth and inflation. You put the two together and this looks like a stagflationary forecast from the Bank of England. This is bad news for the UK Chancellor.
Yeah, kind words, but cruel forecasts for Rachel Reeves, this. The governor saying that he's very supportive, he strongly agrees with her plans to boost growth. And indeed, the cut itself is a boon to the Chancellor. But the bank, as you say, also halving its growth forecast and raising its inflation forecast, which they now see peaking at 3.7% later this year. So it's difficult for Reeves because growth, of course, is the government's top priority. She announced this raft of measures last week to boost the economy, but they won't take effect for decades. And in fact, this rise in the payroll tax in her October budget has, it seems, weighed on the growth outlook in part. It's not just that, but it is a part. And the BOE kind of pointed the finger at the public sector because money's been injected into the NHS, but the plan to overhaul it has been delayed, and they're saying that perhaps that could be part of the productivity problem. Now, Reeves herself said she isn't satisfied with these forecasts. But it's important because, yes, it's up to the Office for Budget Responsibility to decide her headroom, but it suggests if growth is like the BOE says it is, when the OBR comes to its decision, she's going to have to make that difficult choice between spending cuts, tax rises or breaking her fiscal rules.
UK correspondent Lizzie Burden, thank you very much indeed. Let's get to the tech sector right now, because the major corporate right now, in terms of how we think about the spending, the demand and potentially a drag on US tech stocks today, is Amazon. Shares falling in late trade after a weak outlook in its latest results. The e-commerce giant warning investors that it could face capacity constraints in its cloud computing division. That's despite plans to invest some $100 billion this year in AI. Here's Amazon CEO Andy Jassy on the AI outlook for the business.
AI represents for sure the biggest opportunity since cloud and probably the biggest technology shift and opportunity in business since the internet. And so I think that both our business, our customers, and shareholders will be happy medium to long term that we're pursuing the capital opportunity and the business opportunity in AI.
OK, join me now is Matt Bloxham from Bloomberg Intelligence. Matt, what did investors not like? Because on one level, this is a nice problem to have. They have so much demand, yet they can't meet it.
Yeah, it is. And I think it's a little bit of the fickle nature of the markets at the moment. And they've got used to Amazon and all these big tech companies beating and raising. And now we have a beat and or just about in line with expectations for the next quarter. But as you say, I think it's a good balance of problems. It's not a demand problem. It's a supply problem. But it's one that they don't expect to change until the second half of 2025. So we may have another couple of quarters of good growth. Their cloud business is growing at 19% year on year, and it's the biggest cloud business out there. So it's not too shabby. But there may be some lumpiness in that number until we hit the second half, when perhaps that's going to unleash a wave of new supply across the markets and boost revenue again. OK, so we look to the second half to see maybe some clarity on that front. How does Amazon's strategy around AI differ
from its rivals?
Yeah, I mean, I think if you kind of line Amazon up against any of the rivals, there's some similarity there, but Amazon's kind of all-encompassing. They described it, Ali Jassy described it yesterday as he wants to be the AI supermarket. So whatever your flavour of AI is as a company, whether you want to build your own models and you just need the chips and the technology, they can provide that. If you want to use other people's models, you can add that on top, and they've even got DeepSeek into that portfolio now. Or if you want the kind of whole thing wrapped up and you want to just pick agents off the shelf, Amazon's got its own agents, they've got other agents there, so you can kind of get a full end-to-end service. And I think that's quite unique compared to what all of the other players are doing. So yeah, and that's always been their kind of philosophy, I think, on the cloud business. So that's what sets them apart, and I think they're going to be in a really good position to continue to be the kind of the dominant force in that cloud and AI market into the future.
OK, Matt Bloxham of Bloomberg Intelligence with an excellent breakdown, of course, of the earnings coming through from Amazon and their slightly differentiated strategy when it comes to AI. Coming up, President Trump doubles down on his controversial Gaza proposal, as well as his opposition to the International Criminal Court. We have the details next. This is Bloomberg. Welcome back. Now, President Trump has authorized sanctions on International Criminal Court officials who investigate the US and its allies. That's after the court issued arrest warrants against Israel's Benjamin Netanyahu late last year over the campaign in Gaza. Meanwhile, the president has doubled down on his vision for the Strip, reaffirming he wants the US to take control of Gaza. Horizon's Middle East and Africa anchor Joana Bessent joins me now for the latest. Joana, this is a president who is not backing down from possibly one of the most controversial geopolitical policies that he has in his armoury.
Yeah, that's right. And you say it, Tom. In the past couple of days, even his aides tried to dial back some of the language that came through from Trump at that press conference a couple of days ago. But last night, he put out a post on Truth Social where he did double down on those comments vis-a-vis taking ownership of Gaza. He said, and this was in the Truth Social post, the Gaza Strip will be turned over to the United States by Israel at the conclusion of fighting once Palestinians had already been resettled. He said that the U.S. would then work with development teams from all around the world to slowly begin the reconstruction of what would become, in his language, one of the greatest developments of its kind. But he also added no soldiers by the U.S. would be needed. And of course, this is echoing some of the comments that came through from the Secretary of State, Marco Rubio, who said that any transfer of Gazans would be temporary. The press secretary also saying that there was no plan to actually send U.S. troops to the ground. Now, of course, the initial announcement was somewhat of a diplomatic earthquake throughout the region and throughout the international community on several grounds. Number one, it undermines the notion of a two-state solution between Israel and Palestine. A forcible displacement of Palestinians contravenes international law, and in fact, it is a crime under the ICC's governing Rome Statute. And then the third point is that it also undermines and doesn't take into consideration what many Arab nations have been saying and repeating, which is that they do not want to take on more Palestinian refugees. So yes, it has set off a domino effect in the region, and many of the big names from Egypt to Jordan are saying that this is a proposal that is essentially dead on arrival. Alternatively, in Israel, it has actually been met by several members of the Israeli cabinet, including those on the far right, who have welcomed this announcement. And in fact, the Israeli Defense Minister, Israel Katz, said he has now instructed the military to formulate a plan for Palestinians to leave Gaza, which, of course, has been ravaged by more than 14 months of wars. So, yes, the plan doesn't appear to be going anywhere from Trump's perspective.
OK, and you mentioned the ICC, the International Criminal Court. It doesn't seem like President Trump has much affiliation with the ICC. The US is not a signatory, of course, but now he comes through with an executive order. What is the consequence? What is the impact, potentially, of that decision?
Yeah, it's important to emphasize here that the U.S. isn't technically part of the ICC. It doesn't recognize the ICC. But the announcement yesterday from President Trump is also significant. It's symbolic because he is now issuing sanctions against the key officials involved in issuing that arrest warrant against the Prime Minister Benjamin Netanyahu. Now, you remember back in November, the ICC ruled that not just the Israeli Prime Minister, but also the former Defense Minister, Yoav Gallant, had been involved in what they said were crimes against humanity over their military response in Gaza. And Netanyahu subsequently accused the court of anti-Semitism, but Trump has now struck back with this executive order, applying sanctions on some of those key officials, which bars them from entry into the United States and from purchasing property and assets. And I should also just mention that the U.S. has somewhat of a checkered past with the ICC to begin with. In Trump's first term, he labeled them a, quote, kangaroo court once they launched an investigation into U.S. practices in Afghanistan. So there's a whole lot of history behind this, but ultimately it just reinforces the fact that U.S. and Israel's strategic priorities seem to be allied in the region.
OK, an important update then on that front from our Horizons Middle East and Africa anchor, Joana Bessent. Joana, thank you. Switching focus, in the next couple of minutes, we are going to be focused on European companies that are struggling to access proper funding to grow. Many are choosing to list in the US. That is the subject of your big take today. We bring you the details later this hour. This is Bloomberg.
Yes, impact will be negative, but compared with other major trade partners of the United States, we are better positioned and we are vaccinated earlier. The U.S. strong restriction of tech transfer to China, especially semiconductor, in last couple of years, actually make us, our businessmen, to expedite the deployment of their production base from China, outside of China to other areas. So China Plus One policy has started quite earlier.
Vaccinated against tariffs. The governor of the Bank of Korea speaking to us exclusively about how that country is thinking about potential tariff impacts from the Trump administration. Welcome back to Bloomberg Daybreak Europe. Other stories now to bring your attention. Donald Trump has outlined plans for sweeping tax changes, including, interestingly, ending the carried interest tax break used by private equity and expanding the state and local tax deduction, also known as SALT. The carried interest tax break allows private equity managers to pay lower rates on their earnings from investments. The tax change was not one mentioned on the campaign trail. President Trump, meanwhile, has also held a meeting with the CEO of US Steel at the White House amid growing questions over the company's future. The meeting comes before Trump is due to welcome Japanese Prime Minister Shigeru Ishiba. Former President Joe Biden blocked Nippon Steel's takeover bid, and Trump has also said he's opposed to a deal. South African President Cyril Ramaphosa says his nation will not be bullied, using his State of the Nation address to decry the rise of nationalism and protectionism. Ramaphosa spoke after US Secretary of State Marco Rubio said he would not attend the G20 summit in Johannesburg this month. Earlier this week, President Trump falsely accused South African authorities of seizing private land.
We will not be deterred. We are, as South Africans, a resilient people, and we will not be bullied.
Coming up, European companies struggling to access proper funding to grow, with many choosing to take their listings across the Atlantic. That is the subject of our big take today. That story coming up next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. Happy Friday, everyone. I'm Tom McKenzie in London. These are the stories that set your agenda. Treasury Secretary Scott Bessent tells us he backs a strong dollar as he looks to project a sense of stability in US economic policy. Investors watch today's key jobs data from the world's largest economy. Amazon falls post-market after sales forecasts fail to deliver. The CEO warns its cloud computing business can't keep up with AI demand, despite plans to invest $100 billion this year. Plus, investors raise bets on more UK rate cuts after the Bank of England downgrades its growth forecast. So we keep an eye on gilts when they start trading at 8 a.m. UK time. In the meantime, earnings coming through from Denmark's largest lender, Danske Bank, seeing and forecasting 2025 in terms of net income 21 to 23 billion Danish kroner. At the high end, that is well above the estimates of 20 billion kroner. So in terms of the forecast and the outlook for 2025, which we know is crucial for investors, coming in above estimates. We know the share buyback plan is going to be scrutinised as well. They see share buyback plan of around 5 billion Danish kroner. The stock, by the way, is up about 26% over the last 12 months. I want to get the line on net interest income. Net income, by the way, in terms of the fourth quarter, coming in with a beat. It's a beat on net income for the fourth quarter for Danske Bank, 6 billion Danish kroner. And on net interest income, also a beat, 9.2 billion Danish kroner. The estimates have been for 9 billion. So atop the line in terms of net income, net interest income, and the outlook for 2025, pretty decent numbers coming through from Danske Bank. Again, a stock that's also performed relatively decently in the last 12 months, up about 26%. We're going to speak with Danske Bank's CEO at 8:45 a.m. UK time. And it was the earnings story in Europe that powered fresh record highs yesterday. As we check the markets, you're seeing a bit of a pause, a bit of a wait and hold as we await, of course, the jobs data out of the US. But reflecting on the fact that you got gains of more than 1%, 1.2% yesterday across European stocks, and a lot of that was down to the earnings story. Today, futures are pointing lower in Europe by 0.3%. The FTSE 100 here in the UK down 0.3 as well, looking to lose 27 points. S&P futures softer by 0.2% after the gains of around 0.4 yesterday. Nasdaq 100 futures down by 34 points, and the drag could come through from Amazon, given the disappointment around the current outlook for the current quarter. Let's flip the board and have a look cross-asset. We had Scott Bessent telling Bloomberg that he's focused, of course, on the 10-year yield, and he wants to see strong dollar. 4.44 right now on the 10-year. Relative stability across the Treasury curve as we wait for the jobs data, with a print expected of around 175,000 for the month of January. The pound, softer again today after dropping yesterday, down 0.1%. The Bank of England sending some mixed signals after that cut yesterday. 124 on the pound, $74 a barrel on Brent, up 0.6%. Oil prices higher. Gold also eking out further gains, up 0.2%. We check the Asian markets as well for you. The gains that have come through on the HS Tech Index, which was closing in bull market territory, have eased in the session as we get closer to the close this Friday in Hong Kong. Currently, the HS Tech Index up 1.2%. You had seen gains of more than 2% prior. Deutsche Bank analysts, though, say money will move in to Chinese stocks on EVs and AI innovation. CSI 300 on the mainland currently posting gains of 0.7% across the benchmark on the region, gains of 0.1%. The Nikkei, though, down in Japan by 0.7%. The Japanese Prime Minister meeting with President Trump later today. Time now for your Bloomberg Big Take. UK payments firm Zilch is weighing listing in the US instead of here in its hometown of London. That would put it in the growing ranks, of course, of European companies chasing higher valuations in New York, attracted by its deep financial pools. Joining me now is Bloomberg's JP Barnett. JP, this isn't just about Zilch. This is about a number of companies across Europe, startups looking for deeper capital markets outside of Europe. It's not just a London story. It's a Frankfurt story. It's a Paris story. This is an issue for European regulators. What is so different right now, JP?
Good morning. And I would say it goes even beyond the startups and goes into European bellwethers and established companies. The big difference is that the crisis of European capital markets and its decline has become kind of an existential threat. That we don't have a Google and we don't have an Amazon is well known for the past decade. But there's a trend emerging over the last couple of years, not only that we are losing 300 billion in money that has been invested in Europe before, but also more and more companies, new ones and established ones, that have the strong feeling that they can't grow in Europe as much as they can grow in the US. And there's some good evidence to it. If you just look at the rare chip startups or companies that we have in Europe, like ASML, where you see the US depository receipts are traded much, much more than their original shares here in Europe. And it speaks to a market that is really struggling to provide that liquidity and that valuation. You have companies like Germany's Linde who moved its listing, or even like last year when the software maker SAP gained to a record. The headlines were not like, hey, this is great, we have a tech company that is doing well. The headlines in Germany were like, oh, when will the time come that SAP thinks about leaving Germany and leaving the DAX and go to New York? So overall, it has become a topic that goes beyond mega cap and goes beyond like just IPOs and innovation. It goes very deep into the markets. It has become a threat to Europe. The companies have the feeling this is not the place to grow, that's not the place to be, and they move elsewhere.
Yeah, so look, as you say, partly it's a sentiment story as well as the mechanics of these markets. So what is the fix, JP? What are regulators looking at to change that dynamic?
Well, there are a couple of things that need to be done, and preferably yesterday and not tomorrow. The first thing is like that regulators are working on what's called a consolidated tape. So that means like that we have a bigger market, bigger overview of liquidity. Because if you look at Europe, you have like 30 exchanges, a dozen clearing houses compared to the US, very slim and very streamlined infrastructure. So that needs to be consolidated so that people have a better idea where liquidity is and easier to execute big trades. That's one thing. The other thing they're working on is like making listing of companies easier so that you remove the bureaucracy, lots of paperwork, and give companies a chance to go to the stock market, maybe even a little bit earlier and get into that raising money. And then overall, I would say like, and that's probably the biggest issue, you need to change the sentiment. You need to have like the broader public have a feeling that the stock market is not a casino, that it's a good thing to invest for retirement, to create wealth, that there are good opportunities in Europe and not just in the US. You need to change that sentiment within the C-suite of corporations that they feel like Europe is a good place to list a company. We can grow it here. We have valuation. We have support. And that's something that needs changing. We're working on it. Is it too little, too late? Time will tell. But the gap to the US market is pretty big, and it will take some time to close it, not to speak about like being on par with them ever.
Yeah, yes, with an aspiration
sounds a bit depressing, maybe
for the decades. It does a little, JP, but look, European stocks are at record highs, so let's see if they can change that dynamic. Jan Patrick Barnett, a fantastic breakdown of today's big take, which I really encourage you to read, of course, on the Bloomberg terminal and on Bloomberg.com. Now, corporate leaders in Germany say there's an urgent need for the next government to turn the country around. It ties into the big take, of course, and get Europe's largest economy growing again. The CEOs of Commerzbank, RWE and Bilfinger spoke to me at a roundtable event in Frankfurt yesterday. Let's get a sense of what they had to say.
There's hope that if we have a stable government after the election, that we will quickly see a shift in sentiment.
I've never experienced that the sense of urgency is that high. So there is really the pressure to change. So I'm optimistic that it's going to be addressed.
We think actually in the next few years, German industry will perform better based on having that pressure at the moment. But the short-term view is not positive.
We are unfortunately a country of savers and not investors, and we need to change that.
I would not see it as a threat. I mean, it's probably a start of a negotiation. So be prepared, and we have seen what happens with Canada and Mexico. They were prepared to counteract, and then you start the negotiations.
Markus Gräber, Bettina Orlop and Thomas Scholz speaking to me yesterday in Frankfurt. Staying on Germany right now, Porsche has warned that it will take an €800 million hit this year as it revamps its lineup. The sports car maker is pulling back EVs, saying demand has been underwhelming. Instead, it's adding more combustion engine models and plug-in hybrids. But that means its already disappointing profit margins will be at the lower end of its forecast. Back to the US, where Treasury Secretary Scott Bessent has defended President Trump's new tariffs on China, saying they're only designed to ensure fair trade. Bessent dismissed concerns the levies will be inflationary for the US, telling Bloomberg that China will pay the higher price.
China is the most unbalanced economy in the history of the world, and they are in a deep recession right now. They're experiencing deflation, and they're trying to export their way out of that. And we can't allow that. We want fair trade, and part of that is taking a strong position on the currency and the terms of trade.
But what about the inflation concerns that are stemming from the tariffs and tariff threats?
Look, I'm not sure that where this narrative that tariffs for the country putting on the tariffs is inflationary. that we could have a small one-time price adjustment, that as we saw in Trump 1.0, that the deregulation and the other policies, we stayed right around the Fed's target level. So I'm unconcerned about that. I think especially that China now, given all their excess capacity, will, no matter the level of the tariffs, will end up eating quite a bit.
There's a lot of uncertainty around tariffs. We see them threatened or signaled, and then they're taken back. It appears as if this administration might be unfriendly to businesses. Is that right?
I think it's just the opposite. I think this is the most pro-business administration in history. And everything we are doing is going to increase the after-tax return on capital. And as a result, working Americans will have very high real wage growth. That what we've seen over the past 4 years is the government and government-adjacent sectors providing the employment growth. And why have we experienced this affordability crisis? First, there was a massive spending met by increased regulation, which caused inflation. And then government and government-adjacent jobs do not cause real wage growth because they move up at CPI. So, I think that we are going to not only be business friendly, but very, very friendly for working Americans.
US Treasury Secretary Scott Bessent speaking to Bloomberg's Saleha Mohsin. Now, coming up, medical tech startup Robeauté raises $28 million to develop its neurosurgical microbots. We're going to talk brain surgery with the company's co-founder. That is next. This is Bloomberg. Welcome back. Happy Friday. Just taking a pulse check right now of the HS Tech Index over in Hong Kong, which is closing in on a bull market, adding around 45% in terms of the upside that's come through since September, up 1.5% in the session. And Deutsche Bank's analysts saying that the innovation around DeepSeek and the innovation around EVs in China is underappreciated. Investors internationally will need to get exposure to that story. That is the analysis coming through from Deutsche Bank and that analysts. And that note is spinning around social media circles in China. So that's a pulse check of the tech story over in China, listed, of course, in Hong Kong. So from the software of DeepSeek and the hardware of EVs in China to the hardware developments in Europe, because the medical technology startup Robeauté says it's raised $28 million in its latest funding round. It's based in Paris. The company makes neurosurgical microbots the size of a grain of rice. You can see them on the screen, which it says will transform how brains are treated. Its backers include Plural, Cherry Ventures and Kindred Ventures. Joining me now, very pleased to say, from Paris is the co-founder and COO, Joana Cartocci. Joana, thanks so much for the time. Just talk us through what this hardware and what these robots can potentially do and what the go-to market strategy is for the business.
Yes. Hi, Tom. Thanks for having me. Robeauté is developing a neurosurgical microrobot to diagnose, treat, and monitor the brain. So today, brain intervention is quite invasive, and so to be able to change the way we minimally invasively dialogue with the brain, to diagnose, treat, and monitor by attaching different extensions to the microrobot is our main goal. So today we're in preclinical stages, and the first application that we are going for is tumor advanced biopsy to be able to understand what's going on locally in the brain. And the beauty of a microrobot is it can move non-linearly through the brain tissue, not in the blood, to address different pathological areas. And so we're starting with tumor biopsy, and then afterwards we're going to deliver the treatment right exactly where it needs to go in the brain.
OK, so what is the time frame around that? You start with a biopsy. What's the time frame? And what are the regulatory hurdles that you need? Are regulators open to this idea of robots crawling around in our brains?
Well, regulators are very familiar with the limitations of current standards of surgical tools, and so they are very welcoming. We've had multiple conversations with the FDA, early conversations with European regulators also, and there's real appetite for change in this space. There are 1 billion people affected by brain disease. That's 1 in 8 of us. So stakes are very high, and today very little works in the brain. It's not like other organs where, access isn't a real problem. Here, you can't just take an extra slice. If you do that, you might be taking away the patient's ability to speak, to walk, to recognize their loved ones. So precision is a very, very key element, and microrobots will be able to do just that. Of course, we're working with them, with regulators, both in the US and Europe. Closely.
Okay, and when do you expect patients could benefit from this?
Yeah, so we see our first application, so tumor biopsy in the ORs by 2028, and then drug delivery by 2030.
Okay, so drug delivery is another function of these robots potentially in the years to come.
Absolutely.
Joana, talk to us about the importance of the US market. Is the US market your primary market at this point?
Yes, it definitely is. Europe comes with some more regulatory constraints for the category of devices that we're developing, so a class 3 device. And generally, even as a market, the US is a lot larger. It's a more important market in terms of volume. Today, 10% of surgeries, I'd say even higher, around 15% of surgeries are robotically assisted in the US, where it's 3% in the rest of the world. So we have some catching up to do in Europe in terms of adoption of innovative devices. So we'll definitely start from the US, but keep in mind that we do want to be able to treat European patients as well, and we're building a global company. The stakes, as I was saying, are very high, and we were born in Europe, and we want to be able to bring this technology back to European patients too.
Is Europe conducive to that, Joana? You talk about the importance of the US market, the lead they have in automating some of these surgeries versus Europe. We've discussed at length the challenges around raising long-term capital in Europe, the challenges around listing in Europe, the regulatory burden. Is Europe doing enough to support businesses like yours to thrive and grow into global businesses?
Honestly, we can be doing more. We can do a lot more on all those fronts you mentioned. From a regulatory perspective, there was a change in device regulation that made things a lot more complicated for companies like mine. But I believe we have a new generation of investors, of backers, like the ones that joined us in this round, Plural, Cherry, as you were mentioning, the Local Globe, that really believe in creating and in supporting European champions in category-defining industries. So I think we're going in the right way. We can accelerate if we need to keep up. We should accelerate if we need to keep up with America. Definitely.
Okay. You've raised $28 million US. Do you raise again this year? And would you ever consider listing in Europe?
So, very good question. Thank you. Honestly, so we're very early stage. We raised for the next, I'd say, 2.5 years, we're comfortable. And this is going to take us all the way to our human trials, proving that navigation of a microrobot through brain tissue is safe. This is a critical inflection point to secure partnerships, because we're developing an agnostic device to which you can plug multiple extensions that address different pathologies. We won't develop all the extensions. We count on partnerships, so that is a critical point. And this funding that we managed to raise brings us to that inflection point and a little beyond. So we're not raising now, and definitely our ambition is to create this global brand and explore those different verticals. So we do consider an IPO, but for the moment, we would, if I had to choose, go more onto the US market than the European one, for sure.
There we go. That just underlines the challenge, doesn't it? A thriving startup community that we have here, but looking to list in the US. And you are by far not the only one. Joana Cartocci, co-founder and COO of Robeauté. Thank you so much on that raise, around $28 million US, and the ambition to grow into a global company focused, of course, on robotics in terms of some of the delivery of drugs and treatment within the brain. Thank you. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back. Here's a story you may not have expected. The CAC current is back to levels pre the call of that snap election back in June of last year. It has recovered the losses. You saw a drop of almost 10% from June the 10th when those snap elections were called by President Macron through to July. It has recovered, and that's largely down to the earnings story. Banks in particular and luxury coming back and supporting the CAC current. François Bayrou, the Prime Minister, has managed to get his budget through. He faces further political challenges, though, of course. So how long does this story continue? Let's flip the board and look at the macro in terms of the data print today. That is in focus. Non-farm payrolls out of the US. The number expected to come in 175,000, so slightly softer than the December print. Unemployment, of course, and wages in focus. Unemployment expected to stay at 4.1%. Wages, you're looking at around 3.8%. That will be key, of course, from the Fed. Traders pricing currently around 40 basis points of additional cuts from the Fed by the end of this year. Does the data today change that? That is crucial. Let's flip the board and have a look at the University of Michigan Sentiment Survey and how it has diverged from the broader political view stateside. Real Clear Politics showing a sharp tick up, there it is, in terms of US and American expectations that their country is now going in the right direction. So will the University of Michigan Consumer Sentiment Survey that comes out later today play catch up to that view? Americans are feeling more bullish that their country is now on the right footing. Hold on to your coffee, by the way. It is, of course, coffee morning. Fridays, well, every day is a coffee morning, isn't it? It's about to become more expensive, though. The pricing around coffee is in focus. Find out why. We're going to speak to the chairman of Illy Cafe, Andre Illy himself. That's at 9:30 a.m. UK time. There he is. We'll have a conversation about coffee prices. At 9:40 a.m., meanwhile, we're going to discuss President Trump's tariffs and geopolitical moves this week with the former UK ambassador to the US. So stay tuned for that geopolitical conversation as well. How should the UK position as it straddles that relationship between the EU and Washington? The opening trade is up next. Stay with us. This is Bloomberg.